Welcome to the Crypto Teacher. And guys, I come back with that second video just to make you think. And we know the banks control everything. What I teach you is that the fact is that the Fed, of course, has bought everything. Just printing money bought everything, but they have to funnel the money through other banks. So we have BlackRock, we have Vanguard, we have Blackstone, and they just about own every single asset now due to the C word. They just about own everything. And like the gentleman explains in his first video I'm going to show you, is that a lot of times they go through foundations, nonprofits. And if you look at crypto, you see the same thing. Foundations, nonprofits, when they have already hundreds of millions of dollars. But y'all enjoy the video.
Welcome back to Squawk Box. BlackRock shaking up the business world with that decision earlier this week to make sustainability the focus of its investment strategy. I spoke with Larry Fink about why, as the world's largest asset manager, he decided to make what he's calling a fundamental shift.
We believe a portfolio that focuses on sustainability and climate change will be a portfolio that outperforms. So the main component of the letter is saying this is going to be a great investment over the next 10 years.
Joining us right now is Hal Lambert. He's the founder and CEO of Point Bridge Capital, and Ken Taubes, he's the chief investment officer of Amundi Pioneer Investment Management, one of the first movers on the ESG investment criteria. Hal, I want to start with you. You think that Larry Fink is making the wrong decision here?
Well, what the American people need to understand is that there's been a war going on against American companies for at least the past 20 years. It started with a small group of left-wing agitators. It's mushroomed into hundreds of 501c3 companies funded by the usual sources that have gone after the boards of these companies to try to effect policy changes that they can't get passed legislatively through Congress or through state legislators that conform to their view of the world. And let me tell you, they're winning. There's only a couple of groups on the right that are pushing back on this. So while the rest of America's gone to work every day trying to pay their bills, companies have adopted new policies, these social responsibility policies, and now they're using those policies to implement things like defunding, Congress people that don't agree with those positions, trade organizations that don't agree with the positions. And let me tell you, these left-wing groups they don't care at all about the profitability of these companies. They only care about what's happening in their social responsibility world. So yes, I think Larry Fink is making a mistake. If you look at what he said in your interview, Andrew, there were two big red flags in that interview. The first was he said that, hey, when he was writing this new letter on his social responsibility compact and sustainability that he's doing with his investment on the firm level, he was very emotional as he wrote it. Why do you want an investment manager who's emotional about the investment decisions he's making? The second red flag on this was that you asked him, and this is the biggest one, you asked him about ERISA's mandate that you have to focus on the profitability of creating the highest investment returns for your investors. And he said, yes, he knows about that. He wishes he could change it. So he actually said he wishes he could change that mandate that you have to focus on creating the highest returns for your investors. Those are really troubling signs from a company that's now managing trillions of dollars for investors.
There's a good chance you've never heard of BlackRock. Founded in only 1988, in less than 30 years, this American financial firm would grow to become the company that owns the world, managing assets worth $6.3 trillion. These are assets that belong to their clients, mainly the pension funds of ordinary people, teachers, police officers, nurses, and many more. And that's just the beginning. BlackRock has also developed a software platform called Aladdin to perform risk analysis for its clients. It receives sensitive data from banks, insurance companies, and other important institutions. Through Aladdin, BlackRock has insights about the management of financial assets worth another $20 trillion. BlackRock also has shares and voting rights in many of the biggest European companies, in sectors such as energy, oil and gas, transportation, food, and of course, finance. The company holds public debt in the form of bonds and has real estate interests. And still, there's more. Our Rock, you see, wears many hats. Aside from being an investor, it is also an auditor and an advisor. Governments and central banks invite a BlackRock subsidiary called BlackRock Solutions to audit them and to provide advice about the management and rescue of banks. Yet at the same time, BlackRock is often a major shareholder in these same banks. In other words, the company often sits on both sides of the table. BlackRock Solutions gets privileged access to highly sensitive information that could be valuable to BlackRock itself. Does this constitute a conflict of interest? No, says BlackRock, which claims that the company has established Chinese walls between its different subsidiaries. In January 2018, BlackRock's founder and chairman, Larry Fink, sent a letter to all of the CEOs of the companies BlackRock is invested in, asking them to do more than deliver financial performance and make a positive contribution to society. So BlackRock not only owns the world, it also wants to save it?
Where are they now in terms of assets?
So BlackRock is currently on almost 6 trillion, and Vanguard we're looking at about 4.7 trillion at the moment. But that is going to rapidly grow. Looking at the average growth rates over the last 5 years, we could be seeing Vanguard at more than 10 trillion by 2023, and BlackRock hitting that mark a couple of years later at 2025.
It is Titan versus Titan. BlackRock and Blackstone could soon be in a battle for the same business. The companies are said to be diversifying their investments, touching on what one another does best. Bloomberg Bureau Chief Jason Kelly wrote the story in this month's Bloomberg Markets magazine, focusing on rivalries. Jason, welcome. So take us back through the history of the two Blacks.
So the history of these two firms is that back in the late 80s, when Blackstone was first getting started, he met a guy, Steve Schwarzman met a guy named Larry Fink, who was a very successful mortgage trader at First Boston. Fink left his job there. Schwarzman said, come work with me. They made beautiful music together for a few years. Then they had what each has described as a fairly bitter corporate divorce. And BlackRock and Larry Fink went on its way. And over the subsequent 20 years or so, these firms really existed in parallel and became the dominant firms in their respective industries.
But respective industries, it wasn't like they were doing the same thing. Blackstone's competition was KKR. BlackRock's competition is Fidelity.
That's exactly right. And when we were thinking about this rivalry issue and sort of what we could say that was new and different, we did think about Blackstone versus KKR or KKR versus Carlyle or something like that. The interesting thing in private equity, as both of you know, is that Blackstone has really put a lot of distance between them and their traditional, as it were, alternative rivals. What has happened is that as they've gotten bigger and bigger, they're looking at new pools of money, especially retail investors.
Now, you look at this chart here, and you can see that BlackRock, as far as total assets under management, just destroys Blackstone.
It's not even close.
Yeah, 4.8 trillion to 310 billion, but something you pointed out to us, which is not on this chart, is that Blackstone actually makes more money in profit.
That's exactly right. So on the same basis, about $1 billion more per year. And so when you look at how investors are valuing this, you saw that huge difference in terms of total assets under management. But when you look at market cap, they're only about $10 or $11 billion apart. So these are firms that actually are competing not just for some money from institutional and retail investors, but even in the public sphere as well, as companies start to, or as investors try to assess who they're going to invest in.
Well, and before I so rudely interrupted you, you were explaining that they're starting to go after the same clients.
Well, that's exactly right.
Same investors.
The same investors and the limited partners, as it were, and also the retail investors. So Blackstone is seeing the 401k market. They're seeing lots of different things going on in terms of individual investors. At the same time, BlackRock is looking at those profit margins that we talked about and saying, let's get in deeper to infrastructure investing. They have an alternatives business, which has more than $100 billion.
But that's not that easy to do. Just to say Blackstone, they seem to make a lot of money doing that. You can't just put a new shingle outside and say, I'm going to do that too.
Well, that's exactly right. And it's a hard business to get into for sure. There's a guy over at BlackRock running it.
Combination name if they ever got together.
If they ever got together again, that's true.
Sorry, there's a guy?
There's a guy, at BlackRock who used to work at Blackstone, Matthew Botine, who is running that alternatives business. They are hiring into that business. They're looking at that as a very profitable
Okay, you know what my
business down the line.
takeaway is?
Tell me.
Maybe a rivalry, but I'm pretty sure both are doing pretty well.